Lambie-Hanson on institutions and geographic concentrations in VA mortgage lending. And so here is a product that used to be a very small share of the market. It's now a much larger share of the market. What are, why are people using it or not using it? What are the drivers of that? We'll be hearing about that. And Pence will be the discussant there, and Max Besbris will be the discussant of the mortgage earnings paper. So as you're thinking about this, and I just want to encourage us to have a very broad conversation afterwards about whether we have the right products and the right process for helping people attain homeownership. And I just encourage us to think bigger. I'm usually a very cautious incrementalist. I don't like big ideas. They're not going to happen. I feel like we have a moment in time where people are putting big ideas on the table. So here's my big ideas I want to throw out there. If we really want to have homeownership lead to transformational wealth from one generation to the next, what if we had a product that was portable and went with a family so that over 30 years of paying a mortgage, you eventually paid off that mortgage? Instead of resetting the clock every time you refinance or every time you buy a new home. Think about, what that could do if, when next time you buy a home, you're not in years 1 through 7 and paying mostly interest, you're in years 7 through 14 and paying down principal, and next time you're in 14 through 21. Now, is this practical? Huge obstacles, hugely hard, but if we start thinking about the homeownership market from the perspective of the consumer and not from the perspective of the lender, we might end up with very different products. And the question is, are those worth thinking about? What's worth doing? And looking forward to a productive conversation. So we will first hear from Jonathan Spader.
All right. Sounds like the lab is working. So I like to walk, so we're going to do that. I'll start by saying I got home last night to find out that in my family's bracket, I'm losing to my 5-year-old nephew, my 2-year-old niece, and my wife, in that order. So that's kind of where I'm at today. That's the reality. And I'm pretty sure I'm going to get some videos that are my niece and nephew learning to trash talk this week. I'm going to see if they can walk that fine line between gentle teasing and really throwing the hammer down.
John, what's that tie you have on?
Yeah, so if you don't know, this is my allegiance. This is a tie that Roberto and Yannicka gave me when I graduated from UNC, so I thought today was the perfect opportunity for it.
Go Heels?
Go Heels, that's right. Go Heels. So this first paper on the panel is the potential for shared equity to expand access to homeownership. What it is it's an effort to try to measure the size of potential demand. So I'm not going to do a lot of intensive modeling or show you a lot of intensive modeling. External validity is really the focus, and trying to put some kind of quantification to the gap that would be required for various groups of homeowners to be able to access homeownership. I need to say up front, this is a paper that was conceptualized and designed largely by Herbert and Kristin Perkins, and that Kristin deserves a ton of the credit for the paper. So what you see here, I want to be very clear up front that anything good you see here is likely the product of Kristin. She has 2 very good reasons not to be here this morning, so I'll do the best that I can, and in Q&A I may bring Chris in and our other co-author, Shannon Rieger, as well. So there's 2 central research questions that we're trying to answer. The first is how many potential home buyers can't afford to purchase a home due to affordability constraints, and how many is it because of the down payment requirement, income, non-housing debt, and then secondly, how much assistance would it take to close the gap to affordability for those who can't afford a home, and to break that out by geography, income, and race ethnicity. And I'll talk a little bit in just a second about what our unique contributions there are. I want to start with a bit of motivation up front. So when we were designing the call for papers for this symposium, alternative tenure models were one of the things that was on my mind. And there's an emerging literature, well, not an emerging, there's a very established literature on shared equity homeownership. There's increasingly a number of studies on models like Airbnb and others. I haven't seen as much on some of the newer shared appreciation and kind of what's called prop tech models, but I was anticipating that those papers might be coming. And so what we're trying to do in this paper is provide a framing for where those models might fit within or for the size of potential demand for that set of models. I'm going to talk here with respect to shared equity primarily, but the math applies to all of them, so shared appreciation and the like. And there are a number of them. So I'm sure many of you are familiar with the Unison model. The top left there, at one point, a company called Loftium would give you $50,000 or more towards down payment assistance if in exchange you rented a room in your house on Airbnb for a pre-specified number of days and shared the revenue with them. There's a lot of innovation happening within that space, and the math of what we're doing could be generalized to all of them. The method that we're using, we didn't reinvent the wheel. We borrowed from the method that's used by the Census bureaus who can afford to buy a home report series. That's very similar also to the housing policy debate paper at the top. The two contributions that we make here are first, each of those papers talks a bit about the potential of down payment assistance. So how much, to what extent would small amounts of down payment assistance increase the number of potential home buyers that would be able to afford a home? We take that further, and so rather than just looking at $5,000 or $10,000 of down payment, we're actually quantifying the full range. So with deeper subsidy, how many potential households would that bring into home ownership? And the second thing that we are trying to do is to look more finely across geographies. So we have the internal data file of the SIP, and that allows us to see locations, and so we're interested in the kinds of variation that we see across high-cost and low-cost markets. The data, as I mentioned, it's wave one of the 2014 survey of income and program participation. The strength of that data is that it includes detailed information about income, assets, and debts, so we have a fairly complete financial picture. With the internal file, we also have detailed geographic information. The weakness of that data is the time period. So prices have obviously increased since. The 2014 wave actually covers 2013. We're talking about ways that we might be able to update prices, but if you want, just as a rule of thumb or a benchmark, the FHFA Home Price Index suggests that at a national level, prices are up about 33% in real terms since then. So the prices we're going to look at are a bit lower than they are today. So using that SIP, we create a nationally representative sample of what I'm going to call potential home buyers. And what I mean by that is the householder of any renter or no cash rent household. Additionally, any individual or couple age 18 plus who live in the home of a separate householder. So that could be a college student living with their parents, or someone freshly out of college living with their parents. That could also be an older household living with a child. Any instance in which an adult is living in the home of another householder. When we take our sample of potential home buyers and weight them up, we get to about 66.6 million potential home buyers nationally. About 2/3 of those are householders, so they're rent or no cash rent households. About 1/3 are that second category who live with another household. The reason that we want to include that second group is we've looked at a couple of data sets to try to measure among potential home buyers today what share of them are not previously householders. When we do that, it's about 20% from a couple of data sets where we can measure that. So they're about 33% in our sample, so I'm over-representing that a bit, but it's an important group to include in any kind of analysis like this. Okay, so we take that set of potential householders, we see their financial situation, and then we match home values from the 2013 American Community Survey for the 382 MSAs in the 48 non-metro areas of states to get the median, the 25th, and a couple of other criterion home prices. The key measures match very closely to the definitions that are used in the Census bureaus who can afford to buy a home. I'm not going to go into these in detail. So income, we're including social insurance income like Social Security. We're not including, I say transfer income here. That's really its temporary income that you wouldn't be able to use to take out a mortgage. So things like unemployment and the like. You can see the other exclusions here. The one thing I will say is the incidence of those exclusions is pretty minor in our sample. So we don't see very many households at all that have other rental property or businesses or other kinds of assets. I guess I should say with assets, we're defining it really as financial assets and not as businesses or other restricted accounts. So retirement accounts wouldn't be included. So anything that's non-liquid wouldn't be included in the measure. And with debts, education debt, credit card debt, vehicle debt. So the affordability calculations, there's 2 steps to this. The first is we take households and apply them to the median priced home using an FHA mortgage. So do they have sufficient assets to make a 3.5% down payment? Do they have sufficient income to meet a front-end ratio of 31% and a back-end ratio of 43%, assuming closing costs and fees of 3%. From that, we get how many households can afford to buy the median priced home in their area today, given their financial situation. Step 2 then is to reverse engineer for those who can't afford it. How much assistance would it take for them to be able to meet the down payment and income requirements? So for some households, that's just sufficient assistance to meet the down payment. For others, it's actually buying down the mortgage amount. The paper has more details about exactly how we do those calculations, and within the SIP it gets complicated. But I will say we allow homebuyers a little bit of flexibility to reallocate their assets and debts to make it optimal. Essentially, we're calculating the minimum amount of assistance if they put all of their assets and income to full use to try to be able to qualify for a home. And we don't allow them to use the assistance to pay down non-housing debt. So if they have non-housing debts above 12%, they can use existing assets to try to pay those down to 12. But if they can't use their existing assets to reduce their non-housing debts to 12%, we just code them as not able to afford a home. So a couple of descriptive statistics on our sample. These are representative estimates of our potential home buyers. To highlight a couple of things, you can see it's very much skewed to the lowest income group. Those categories represent approximately income quintiles of the whole distribution. Almost 60% of potential home buyers fall in the group less than $25,000. About a third are in the $25,000 to $75,000 range, which is what I typically think of as potentially a target for low and middle income or moderate income home buyers. The third category is our measure of MSA price to income ratios, and you're going to see that one come up in a few of the slides. It's basically the ratio of the median home value in an MSA to the median income. The bulk of our sample falls in the third category with about 20 to 25% in the low and the high cost markets. To give a little bit more intuition, since we are using 2013 home values, the usual suspects are in the highest cost markets, those with price to income ratios above 5. The median value within those markets in 2013 was about $350,000, and you can see the differences across different groups. And we can talk more about, I would be interested in ideas about creative ways to try to update those values to today, inflating with a home price index, potentially inflating incomes and the like. So this is the first descriptive table of results. The top panel here shows the percentage of households that face each barrier. So 85% of potential home buyers don't have sufficient assets to make the down payment on a median value home is the way to read that. 80% don't have sufficient income to meet a 31% front-end ratio on a median value home. The number of barriers then shows you that 7% of potential home buyers would be able to afford a home given their income and assets at the time of the survey. That nicely dovetails with the census who can afford to buy a home. It's almost exactly what they come up with, which gives me a little bit of comfort in our calculations. You can see that the most frequent category here is facing 3 barriers. Those are largely households who both don't have sufficient assets to make the down payment and don't have sufficient income to meet either the front end or the back end ratio. Okay, so this then becomes the first kind of primary table of the results, where you can see the breakout in more detail of the amount of assistance that would be needed. So again, 7% of households could afford to buy a median priced home. The 28% in the unable to purchase includes 2 groups, so a little over half of that group has 0 or negative income and therefore wouldn't meet any of our calculations. A little under half of that group is the set that has non-housing debt that they're not able to reduce to 12%. And so first takeaway from here, if you're looking at the assistance amounts, is that 24% with $7,000 or less of down payment assistance would potentially be able to afford the median priced home in their area. That's a national number, obviously, and will vary across MSAs, but I thought that was a bit higher than I might have expected. The second thing to highlight is that there's about 12% between 25,000 and 100,000, which is where I typically think about shared equity fitting in. That our scan of shared equity programs suggests that that's a fairly frequent amount of subsidy. So this then separates those estimates across high, medium, and moderate and low cost markets. One of the surprises here is that, so in the high cost markets you see two lumps. One is the $10,500 to $25,000 amount of assistance. Those are largely households who just need help making a down payment, right? So for a $350,000 home at a 3.5% down payment, you're going to be a little over $10,500. The other large lump is the 27% who need over $100,000 in assistance. Those are households that are facing both barriers. I was a bit surprised that only 3% are falling in that category of where I would think, might imagine shared equity might fit best. And that might not be surprising to you. I'd be interested to hear for those that have studied shared equity models. It was a little bit surprising to me because I think of high cost markets being one of the more desirable or an area that has more opportunity to apply those models. But you can see that the distribution gets quite a bit more flat as you move into moderate and lower cost MSAs. And then we drill into the numbers in a bit more detail, focusing on the $25,000 to $45,000 range and the $45,000 to $75,000 range. There's a couple of things that jump out of this chart. The first is that the share of households who can afford today varies substantially within these groups. So when we zero in on the low and the moderate income households, there's huge variation in the share who could afford today, as well as in the amount of assistance needed. So this looks a little bit more like what I might expect. So in the highest cost markets, almost 2/3 would need more than $100,000 of assistance. There are 6% of households that would fit in that 6% range, and 13% of households fall in the less than $25,000. You can see the same basic pattern holds in the $45,000 to $75,000 range. So you can see the bulk is over $100,000 for the high cost markets, and less than $25,000 in the lowest cost markets. So our question, I mentioned at the beginning, our goal here is not to do extensive modeling here. It's to produce estimates in the revised paper that give both the number and the share of households within different groups. This is a first cut and what I can cover in 18 minutes, but we would like to extend this in a few ways, and I am open to feedback about the different groups that you might like us to drill down into in those revisions. So our next steps from here, we'll produce separate estimates for renters versus the potential homebuyers living with others, both the number and share of households across each of those groups. We think that's useful as a reference point to get a sense of the amount of subsidy required for various potential homebuyers. We're looking at options to update the home values from 2013. Again, suggestions there are welcome. And then the third is, I want to drill down in more detail by geography, as well as into some subgroups of interest. So, we have right now 3 categories by price to income ratio. I'm not necessarily sure that those are the right 3 categories. We could break those out in more detail. Any input you have would be appreciated. So I will stop there.
Hot mic. Hi, I'm Theodos. I work at the Urban Institute in DC. Happy to be here. Happy to comment on this paper. Have done a good amount of work on shared equity, so I was very interested to see this. I'm also confident that this top line figure is going to be cited and used widely, so I think it will matter. I have a number of smaller comments on the paper that I promised to send to you. Hold me to that promise, Jonathan, and I'll focus on some bigger figures today. One is, I think there's some ways that you could help the text even more reach what I think is the more important audience for this particular work, which is a more policy-oriented audience than an academic one. So I would encourage you to rethink at some point some of the analytic decisions, but absolutely even more some of the messaging decisions. and to include the structure, and you can produce a derivative product that is more oriented to that, because I think that is where this work in particular is going to have more importance and salience. One thing could be, I think there's some points where the text can be shrunk, and what would help is either a formula or a summary table for some of your definitional, because there's a lot of moving parts, so encouragement in that arena. I like the inclusion of non-renters as potential buyers. I think that's important. In studies that I've done of shared equity programs, they're definitely attracting people from other living arrangements than currently renting households. So I endorse that. I wanted to know more about the households who could buy these 8 million folks. I wanted to know family structures, presence of kids, ages. You have some information about them, but I thought we could round out the picture of who these people are. And I wondered, and I don't know this very well, you have information about MSAs, but MSAs are really big sometimes, at least. And so I wondered if you could get any smaller, especially because the programs that I've looked at, most people are trying to stay in their same city or their same county. So could you do even, I realize you can't report all of these, but in your actual analysis, could you zero in more there? You previewed this comment that 2013 feels dated. I don't know, it's been a long time since I worked with the SCF, but could you replicate this, at least the top line stuff, in the SCF and get more?
The national estimate.
Right. So why not, and see how that is affecting things, and then you have a real insight into some of the points there. But then, yes, also encourage, just since a lot of these are assumptions, carry on with them and make some assumptions about home price trends. You could do that by geography and get a little bit sharper about it. Income and debt changes relative to, some of the other things about people could let you get a little further there. Smaller point, but the reason I wanted to say it is mostly so all of us could hear, and myself as well, is I'd like to see Asians carried through the analysis. They're now at about 6% of the US population. I think we all can do better at identifying that racial group along with some of the others. Okay, and then some definitional questions or suggestions. So I don't terribly dislike the who can afford to buy a home definitions, but I would articulate more clearly in the paper why you're using them. So I think there's some distinctions between we want to replicate what the credit box is to the best of our ability versus we want to replicate what we actually think people should be paying for housing versus we actually want to replicate what we think they could be paying for housing. Especially some lenders are not following those FHA requirements there. So I think more justification and just thinking through how the choices relate to those different aspects. Just by way of example, it looks like you're not including medical debt or installment debt in the calculations of debt. To me, that's very important in thinking through whether you can actually afford to buy a home. But I realize, depending on what motivation you have in that, you'll get a different reason there. Similarly, but a little different in defining who these people are, I would love to see some elements become absolute just cuts, and people are just not included. Like, if you're below 25, pick an age, whatever age you want to pick, but maybe you have a temporarily low income, and that waiting a few years could mean that you could qualify for a home absent this kind of support. And shared equity really is about capping your upside, so you don't want it unless you need it. And so encouragement to think about maybe some subsetting of age. Similarly for the people who are in their older years, we heard about this morning, if you don't own a home yet, are you very likely to enter into a shared equity arrangement? I think you could narrow in that population to some extent. And I think you could do more than just absolute cuts, but you could begin to think through some more sort of probabilistic conditions to better replicate who is going to become a buyer. You could, more of a Bayesian paradigm than perhaps you've been thinking to date, but can predict who is likely to buy. I ran a study where we had information about who became an applicant to these programs and then who became a buyer. And so you could think around, and Emily has data from a lot of programs of who's made it through as buyers. So you could think through who actually are these people, what do they look like, and how do we best create that mix from the population that we have. One thing, just by way of example, that was surprising to me the first time that I saw it is in the programs that I've studied, a relatively high share of folks have college degrees. And that's something that may not have been fully thought through beforehand. Okay, so, and then in terms of income categories, some of these programs have caps at 80% of AMI or 100% of AMI. So you could think of less just the income than the income relative to median incomes as a way to create the categories. I like saying that shared equity subsidies start at 25K. I strongly dislike saying they end at 100K. I think that really narrows the analysis, and I think that in a way distorts your conclusions about which markets it's useful in. 100K in Duluth, a program that I've studied, that goes a long way, and actually they're not putting that much subsidy into their homes. But in DC, I'm helping now in the guiding board for our first community land trust, the Douglas Community Land Trust. We have 0 homes in our portfolio, so we're not helping with the numbers there, but we're working on it. We cannot produce homes for $100,000 in DC. You probably can't do it here in Boston. You can't do it in the Bay Area. You're putting hundreds of thousands of dollars into each unit. And I realize on the one hand, you articulate that is less feasible, but if we are going to support homeownership in high-cost markets, shared equity is what makes the most sense, because it's exactly in those environments when we're putting literally $300,000 into a single home to make it affordable that we have to recoup some of that equity because it's just too much to get back or to give to just one household. And then another dimension, and I'm not 100% sure how to wrap this around, but we've heard from several programs that homes need to be at least 25 to 30% priced below market in order to make them attractive to buyers. So I haven't thought that all through, but I wonder if there's a way that you can incorporate that into the actual model. Okay, quickly, since I'm running out of time, I would love to also have you think a bit more about for whom shared equity would be a helpful thing. It's not helpful to cap your upside if you can buy a home outright, or you could wait a year and do it. So building in a little bit more about cost of ownership, maintenance, or projected returns, you might narrow your group a little bit more as well around for whom would this actually be a beneficial policy. In terms of something that I think would be really helpful for policymakers is articulating how much subsidy is needed as a top-line measure as well and by group. And then I alluded to this already, but hot markets, right? Okay. And then, yeah, you say at one point that it's in the hot markets that people's appreciation is tapped the most, and that's less attractive to them. But even if that's the case, they can still make a lot in nominal dollar terms. And I guess a last comment that I'd love mentioned in there somewhere, and this is, I'm spending a lot of my time thinking about opportunity zones, and these programs are like the anti-opportunity zone design in the sense that they're self-limiting, right? There's a built-in self-selection approach. You don't want it if you don't need it because you're trading away something for it. And so I'd love to see you kind of bring that forward a little bit more, the implications as a really good design feature about these programs, and then emphasize the cost savings as these homes can trade over time. So when you're thinking about your cost of production of doing these many things, how that will continue to pay off over time. Okay, thank you for the paper.
Thank you. I'm Anna Jefferson of Apt Associates, and I'm presenting work that was conducted with my colleague Hannah Thomas, who's here, under contracts to Fannie Mae. So I want to thank our clients, Lee Kwong and Steve Degendorf, for their support and encouragement of this sort of atypical project. You know, if you're Monty Python fans, now it's time for something completely different. And so, with that said, also, anything great I say we can take communal credit for, and anything crazy or stupid I say is all my fault. Okay, so we were motivated to study the mortgage shopping experience of low and moderate income home buyers, first-time borrowers. So everybody in this room, I think, is aware and interested in expanding access to homeownership for low and moderate income home buyers. The benefits may be a little bit murky on the financial side, but there are social benefits, civic benefits, educational benefits, you know, health and civic participation and so forth. And so if we're interested in the question of expanding access to homeownership, we also want to understand mortgages, because as Jeff said, mortgages are a crucial part of almost every purchase, especially in LMI home buyers. Mortgage shopping matters because there's evidence that mortgage shopping behavior influences the quality of a mortgage that someone takes out. It influences the price. And so if you're looking at certain mortgages, it can be $3,500, $5,000 over the life of the loan. And if you're a low and moderate income home buyer, that makes a significant difference for you. And so mortgage shopping matters the most at the lowest income home buying levels. So previous research has shown that there's overall pretty limited amounts of comparison shopping that happens for mortgages. Somewhere between a third to half of home buyers don't do any shopping around for their mortgage. So there's a real potential for limitations there. There are also some limitations in what we can learn about from previous research. Most of it has been done on a survey basis, and we've gotten great information about aggregate trends in mortgage shopping behavior and the sources of information that people draw on. But we don't actually have real-time information about that. A lot of surveys happen, and of course many of them happen with people who have successfully bought homes, so we don't know about the experiences of prospective but frustrated or unsuccessful home buyers. And we also don't really know what people mean when they talk about mortgage shopping. Definitionally, what does a home buyer think mortgage shopping means compared to somebody who wrote a survey? So I don't have on my anthropologist scarf. I've gone over to college as a policy analyst, but that let me design a video ethnography approach to this question, where we wanted to understand this process from home buyers' own perspectives. We wanted to know in real time what was happening. Instead of asking you 6 months after your loan closing, and you're like, it's over, you know, what did you do? Well, I was extremely proactive, and I shopped around, and I talked to everyone, and I got great advice from my lender, because I'm pretty happy in the house that I live in, now that the boxes are unpacked. Instead, we wanted to know about the mess. We wanted to know about the ups and downs. We wanted to know about the confusion. And so we equipped people with video cameras to tell us about that in their own voices. We asked people to do this about every week for the time period that they were in the study. We recruited people who were confident that they were going to buy a home within the next 6 months, and they were true first-time home buyers, not product qualifying first-time home buyers. So they didn't have any prior experience to draw on. In addition, we interviewed people multiple times. We did 3 interviews with each person, so it gave us an average of 10 hours of interviews per person, plus the video diaries. We observed them doing home buying activities like going to open houses, meeting with loan officers, and we observed mortgage closings for I think we observed 5 closings out of the 7 closings that happened in the sample over this period. Obviously, there are limitations in the size of this sample. We looked in basically 2 markets. Around Greater Boston, we had 1 person in Worcester. So we got a view of activities and behavior in higher than average cost markets, and in East Tennessee, which is a lower than average cost market. If you want to hear more about the recruitment criteria or the participants, I can tell you later, but I'm not going to spend time doing that. I'll just tell you, the benefits, as I've mentioned, give us that real-time feedback, and we build richness in understanding and rigor in understanding through the depth rather than the sample size. So we identified 5 major influences on mortgage shopping behavior. I break those out into a set of contextual factors, which are things that are going on for the home buyer before the transaction. They sort of bring all of this to the table with them, as an individual. Financial self-perception was something that we found to be pretty interesting and influential in the way people approach the process. Can people still hear me if I move? Yeah. Okay. So 3 that I want to highlight as particularly important were people who self-perceived as having low credit or being uncreditworthy. Those who self-identified as being averse to debt. So if you work in the financial literacy field, people who follow the debt snowball and the cash-free ideal, it's a really big identity issue to take on a giant loan that's going to last for potentially 30 years if you identify as somebody who values living without debt. Thirdly, people's racial identities, especially for the Black participants who were both African American and Asian American, really affected the way they expected to be treated by financial institutions because of their awareness both of the history of redlining and the subprime crisis that we were coming out of. And so that affected the lenders they were going to approach, how they expected to be treated, and sort of some protective self-projecting that they did to look very organized. People also bring their personal relationships into the process, family and friends, of course, but then access to other kinds of relationships are of great, potentially great value, depending on the type of advice. So I'm just going to highlight 1 participant in Boston who's a moderate income person who through her family network had a family friend who was a financial advisor. So she was able to tap into a great set of professional advice that she might not be able to get through the marketplace. And then we considered access to both financial and non-financial resources. Several people did end up borrowing money or receiving gifts from family members, and also were able to rely on expertise and advice that they could offer them. There are home buying specific factors as well once people enter into this transaction. The role of the trusted professionals that they engage with really can't be overstated, and I know that Max's work speaks to that. And it can vary, as Jake said yesterday. It can be a lender, or it can be a real estate agent, or it can be these conglomerates of sort of unofficial or official partnerships between realtors and brokers. So once you connect to one, you're sort of piped into that professional network, and it limits the information and the products that you might receive because of that. And finally, as people went through the process, they developed preferences for certain mortgage products. There were a lot of folks in our sample due in no small part to the barriers John mentioned of not having sufficient down payment assistance, of being interested in housing finance agency products that offer down payment assistance or lower closing costs or subsidized interest rates. Another participant really wanted to avoid PMI. He was one of the small number of people in our sample who was explicitly motivated, it was one of his motivations to build wealth. So we can talk further about the actually small role that wealth building played in the motivations of people in the study, because I think that's interesting from a policy perspective. When we move from these influences into phases of the home buying process we identify in the paper, I want to bring them up first because they continue to be at play as people move through the stages, and they influence mortgage shopping behavior. We talk about three discrete but not necessarily linear phases of the home buying process. The key issue going on at the preparation stage is all of these checkbox steps to work on credit score and save for down payment and prepare financially. But there's also a major identity shift that goes on for people who are entering into home ownership. And to Brian's point earlier, the culture and the ideology around home ownership and moving along the conveyor belt towards adulthood or having a normative type of family experience plays a big role for people. And this phase ends pretty much when people engage with professionals and they start looking at homes or engaging with a lender. The decisions phase is really where the rubber meets the road, and one of our participants called it the cycle of decisions, because you're weighing the balance between all of your preconceptions and your desires and then the reality of the availability of housing stock in terms of where it is compared to your desire, how much it costs, the condition that it's in, and any changes in your financial picture. So people reevaluate their choices at many times during this phase. And then the key mortgage activity is getting a pre-qualification letter. I'll talk about mortgage shopping in the following slides. This phase of decisions ends when there's an agreed purchase and sale, so a specific home is identified. And then it shifts into a deadline-driven, super high-stress, highly structured process. And it's very emotional and very taxing on people's bandwidth and very stressful. So in the next slide, I'm going to highlight the ways that people did mortgage shopping activities in each of these phases. There are mortgage-relevant activities in each phase that affect what happens later, and I compare them to the best practices advice that's been distilled by the CFPB. There are other sources of this, but we're just using theirs as an example. So as I go through the next 3 slides, I want you to sort of notice how the balance shifts from having a bulk of boxes checked in best practices followed towards having more boxes checked in best practices not followed. So what we saw was that early on it was relatively easier for people to follow best practices advice to assess what financial resources they could bring to the table and decide on how much they wanted to spend on a home and do some education. Those are in the variations on best practice category because either we saw some participants able to do these things but not others, or we saw people doing sort of incomplete versions of these. For example, a homebuyer education didn't always mean going to a homebuyer education course offered by a professional. It might be going to a seminar offered by a realtor or realtor and lender team, or it might be talking to family and friends or peers who recently bought a home. We didn't see people considering the total cost of homeownership in anything near the degree of care that Chris did when he was constructing the IRR. And we didn't see anyone at the early stage creating a loan application packet so they had all of their documents ready to go. The most significant mortgage shopping happens in the decisions phase, which may not be surprising, but it relates to selecting a lender to get a pre-qualification letter. And some people in our sample did approach multiple lenders for pre-qualifications. Many did not. And the decisions that people make at this stage about the lender tend to be sticky. People don't tend to reevaluate these. And when you get the pre-qual letter, there's a lot of information that you don't know. Namely, what house are you going to buy? How much does it appraise for and what condition is it in? And those are really significant factors in pricing the loan. Once people transitioned into the purchase phase, there were really 2 tracks happening, both on very tight timelines set by the purchase and sale agreement. Usually you put in a 30-day window, which is the amount of time it takes to get a loan underwritten and closed, assuming normatively that you know what loan you're going to get. which doesn't accord with best practices advice on shopping for a loan when you have identified a home. So people were very focused on the track of complying with all of the requests to submit documentation to get that loan closed, right? So that high stress deadline is setting the tone for all of the activities. We didn't see people approaching multiple lenders, requesting multiple loan estimates, negotiating their loans at this point. The only shopping around we saw was enforced shopping around when something went wrong with the underwriting. And so we saw a couple of people, for example, one who had pre-qualified for a housing finance agency loan, but his freelance income wasn't included in that. So it bumped him up over the income threshold. 2 days before closing, the loan officer said, oh, that's not going to work anymore, so I can get you into an FHA loan, but I need $5,000. And so they were lucky to have family and friends who could save that purchase for them. Other people were attached to products and couldn't find lenders that would work with their products. So what does all this mean, and what should we think about doing with it? Top line, the current structure and process of the mortgage transaction isn't working to support shopping around. It doesn't work to support comparison shopping. This may leave the most financially vulnerable homeowners unable to access the best match in terms of the product or receive the most competitive price, especially depending on the information networks they're tapping. And both the time pressures, set by that purchase and sale deadline and the paperwork burden are among the factors that discourage people from shopping around once they've identified a home. So what can we do? Federal agencies have a lot of different levers that they can push on given the multiple ways that they interact with and shape and support the housing market. We would love to hear your ideas because there are great thinkers, very thoughtful, creative folks in this room, and we'd love to hear that in discussion. Some ideas we had were to use the principles of human-centered design that have been storming other areas of public policy life, but seem to have not really made an impact on the mortgage industry yet. Take these seriously as the barriers and friction points and start to redesign the process towards smoother transactions. Potentially consider a common mortgage application so that all of the backup documentation only has to be submitted one time and you can receive comparison quotes. And pre-purchase mortgage education could be done in different ways, taking stock of this project's insights. I'm done. Maybe traditional housing counseling, maybe home buying coaching that's a little bit lighter touch and more individualized. And as I'm stepping away, no one should forget about the power of HDTV.
So thanks, Anna and Hannah, for the paper. It was very detailed and I think very admirably exploratory in a way that a lot of showing us what qualitative work can do for an audience like this. As you noted, there's some fairly large gaps in how consumers come to a particular mortgage. So we know there's a lot of variation in mortgages. We've been talking about that yesterday and today. And we know that different kinds of mortgages can have very different effects for people's long-term financial health. And I think what you're doing is a great service by sort of starting to investigate how consumers actually find a mortgage, get matched to a mortgage. And in general, consumer preference, right, is something that I think is sort of like in the ether a lot of what we talk about, but this is actually sort of substantively investigating what those preferences are, what they look like, and how they actually lead to particular market outcomes. I think additionally, right, you made this point that the mortgage data that we do have from consumers tends to be very post hoc. This is like data from Honda, where we have some important demographic differences, right, in terms of who's successful or unsuccessful. But these data don't really tell us about the process, certainly, the nuance and the variation, and observing people as they go through the process as opposed to asking them retrospectively obviously avoids a lot of different potential biases, and more broadly gathers data on both what the obstacles are to overcome for all kinds of mortgage seekers. So the last contribution I really want to highlight that you're making, right, is this focus on failures, right? Which is understanding failures for the reasons behind people's inabilities or change in their preferences while they're going through the process for securing mortgages, I think are really, really key for forming good policy for helping people out to get the kinds of financial instruments that best work for them. And I think the kinds of barriers that your interviewees identify at various stages of the mortgage seeking process are really specific enough, I think, to develop really targeted interventions that are going to improve the process for first-time mortgage seekers. In terms of places to, to think more generally, I think you want to do some work to tie your findings to existing literature on home-seeking behavior more broadly. What comes through in this paper a lot is that personal relationships matter a great deal, as do relationships with market intermediaries, particularly real estate agents. And real estate agents and other market intermediaries like mortgage brokers have a great deal of influence in terms of dictating what people think are appropriate instruments, appropriate mortgages. There's of course a growing and already very robust literature on how real estate agents shape seekers' decision-making, particularly when it comes to variations in their race ethnicity, right? So decades of audit studies showing how real estate agents treat people very differently. But I think more recently, and probably more relevantly, there's work that shows that market intermediaries, including brokers, mortgage brokers, real estate agents, appraisers, they're very influential in people's decision-making because they select certain traits of buyers very quickly, sometimes race ethnicity, but also cultural affinities, gender, whatever it might be, and match them to neighborhoods in this really rote way that doesn't necessarily take into account financial variation across their clients. And so I kept wondering to some extent if this was the same in mortgage shopping as well. And the work that I'm sort of thinking of more broadly is this recent book by Kristin and Crowder about the home search process, which demonstrates that home seekers are operating in very highly limited and very highly segregated information environments. So like you say, right, that individuals are drawing very heavily on their social networks or personal relationships when they're searching for mortgages. They're absolutely doing the same when they're searching for neighborhoods and when they're searching for specific housing units. And I guess the way to put it is, I think it was Chris or maybe Richard approached a table of sociologists yesterday at the reception and said, oh, birds of a feather flock together. And this is something that sociologists know a lot about and talk a lot about, which is to say that the findings that you do have, right, about people using their networks to even find the real estate agents who are they're using their networks to find the mortgages, this process is iterative in how it gets segregated and how it gets limited. So I kept wondering sort of how much of people's mortgage decisions into even their sort of possible exposure to different kinds of mortgages is really predicated on their social networks. And so one way I think to frame the paper would be something like, look, here's all this data on the home search process. We know that it looks very segregated, that it's also very iterative, right, in the way that you presented in your sort of stage, right, but iterative in that people narrow very quickly based on their limited knowledge of particular places, and then narrow even further depending on what their real estate agent essentially tells them. Is the mortgage process similar or different, right, in the sort of staged and iterative way that people go through their shopping. And obviously, for all the reasons you mentioned, it's really important to know why, because these mortgage differences have long-term consequences. There's a ton of narrative richness in this paper, but I did find myself wondering sort of about representativeness in a very very general sense, which is to say that I think obviously you're interested in understanding process, but I wanted to know, since I'm not super familiar with it myself, what exactly do current quantitative survey data actually say, right? And maybe using it a little bit more to motivate some of the questions and tell the reader more or less how the processes that you're finding are more or less expected, given what we do know from existing survey data. Now, for policy, you mentioned, I'll return to this sort of main theme about intermediaries and social networks as being, I think, really, really key here. Now, so some of the things you mentioned in the paper, right, creating a mortgage application portal, an underwriting clearinghouse, more housing counseling, individualized coaching, more media on HDTV about how to prepare financially for buying a house or what to fill out for applying for a mortgage. I think these are all great, right? We do know that from research on, for example, housing voucher holders, that counseling actually improves people's outcomes a great deal, creates a lot more stability when people have that one-on-one information. But this does not address what I think actually are your key findings, right? Which is that real estate agents, mortgage brokers, and other intermediaries, right, are all incentivized to do their work in very quick ways. You note that this makes people feel extremely stressed. The process itself is super emotional. So I would say let's take the onus off of individual mortgage seekers and start to think a little bit more about regulating the intermediaries. Now, just to give you a sense of what it means to be a real estate agent or a mortgage broker, no state in the United States requires more than 130 hours of classroom time to become a real estate agent, and that's way above the average. Actually, the average is about 60. Here in Massachusetts, it's about 40 hours. In Tennessee, it's about 60 hours. It only requires 20 hours of instruction to become a mortgage broker. These are not complicated occupations to enter, and I can say from having audited plenty of real estate licensing classes in New York State, they don't actually learn that much about fair housing, about ethics, about the mortgage buying process more generally. So I would just sort of say that one thing that I think the paper can do and should do is think about policies that are really more about regulating these intermediaries and their relationships with their clients, because we know that they come as a package often, right? You get a real estate agent, you get a mortgage broker, right? And so thinking about how to relieve consumers themselves from the burden of having to make all the decisions on their own. Thanks.
Good morning, everyone. My name is Kerry Spitzer. I'm at the Institute for Healthcare Delivery and Population Science at Baystate Health, which is out in Western Massachusetts. And this work was started when I was just down the street at MIT at the Department of Urban Studies and Planning. So while I'm doing healthcare these days, I spent a lot of time working on housing issues specifically related to veterans and service members. So this work is a joint work with Lambie-Hanson, who's here today, and she may jump in to answer some questions. And I need to state that this work reflects the views of the authors and not necessarily those of the Federal Reserve Bank of Philadelphia or the Federal Reserve System, which is at the Fed in Philadelphia. So as I said, this work grew out of work I was doing when I was at MIT, and it's started about 5 years ago and 5 children ago, if you combine the two of us. So I'm really excited to have returned to this and have a reason to return to this, which is this seminar. And let's get started. So I think most of the people in the room here are familiar with the VA Home Loan Guarantee Program. It was created in 1944 through the Service Funds Readjustment Act, also known as the GI Bill, which was a bill that was designed to help smooth the transition from the military back into the community for all of the veterans returning home after World War II. The program is one of the lowest cost options for vets. It requires no down payment and at the same time also no private mortgage insurance. The qualifications are somewhat complicated. It depends on your era of service, how long you served, which if you're a guards person or a reservist, but typically anywhere from 90 days of service up to 2 years of service are needed in order to qualify. So it's actually really nice to follow Anna's paper in that what motivated this was thinking about veterans. You know, they're a really interesting population because at the same time they're more likely to be homeowners. They're also more likely and overrepresented in the homelessness population, and that's kind of how I started thinking about veterans. My prior work was a lot on homelessness issues, and there was a survey in 2010 of veterans. And 66% of those who actually owned a home had used the VA Home Loan Guarantee Program. And they asked those who hadn't used the program, you know, why didn't you use the program? And over a third responded that they had no idea about the program. So I think this gets back into those questions we were asking about social networks. And we wanted to look also at the role of institutions, specifically VA institutions, veteran service organizations, and military bases in particular. Now, there are also several people who argued that conventional loans or FHA loans were easier to obtain, so clearly there are some administrative hurdles that are associated with the VA Home Loan Program. And then there were 8% who actually said that their realtor or their lender had actually steered them away from using the VA Home Loan Program. And I'd like to point out that there was just a recent report since we submitted this paper from the Consumer Financial Protection Bureau that showed that this use of the program has actually gone up considerably. Now it's about 78% if you look at 2016 numbers, I believe. So we really wanted to understand, you know, vets talk to each other at places like veteran service organizations, vets talk to each other at VA medical centers. I've done a lot of qualitative work actually with veterans and talking to them. You know, we might think that the medical centers are where they're just going to get their doctor's appointment, but it turns out that often these are hubs of activity for veterans. Organizations like the Disabled Veterans of America often are co-located with VA medical centers. So I think there were some reasons that we thought these VA facilities would potentially be helping to spread the word about VA home loans. So we wanted to see if we could see that effect in the data. So work on the VA Home Loan Program in particular has looked at the debate about how much it's contributed to suburbanization in the country. And that's debated by historians. It's also, there's some work that's shown that the VA Home Loan Program has effectively decreased the age of first home purchase, and this has helped to increase rates of home ownership. There's some suggestion that the VA loan program may actually be increasing prices for non-VA borrowers. There's also a lot of research about how access to VA programs, including the VA home loan, has contributed to increased civic participation among veterans. And there's some really recent research out in 2018 that suggests that veterans live in more integrated neighborhoods, and this may be driven in part by the use of the VA home loan program, which is nice because historically, if anything, this program has actually contributed to the segregation I think we're seeing in that back in the 1940s because of the racist and sexist lending practices that were in place then. It was actually not really open to women or service members of color. So just to go through the numbers, the blue line here represents conventional loans, the FHA loans are the red line, and the orange line is VA loans. So you can see it's always, you know, been kind of the lowest level, but it's been growing substantially in the past few years. And when we first started this, you know, it was back in 2012 or so, and we thought, oh, we're seeing that it's countercyclical with the housing market, and I think we've seen that it's continuing to increase even as the housing market's improved. And as I was just talking to Lauren about this, we think it's also partially because the credit markets haven't improved as much, so there aren't as many opportunities for people to get these low or no down payment loans. In fiscal year 2017, there were 740,000 mortgage loans. Less than half of these, just under half of these were refinancings, but they represented 9.4% of all mortgages. And this is 3 times the volume of loans since 2005, 2007. So here you can see the orange is the volume of the loans, and that's been increasing, but the share, the black dotted line, has also really been dramatically increasing in the recent years. The distribution of these loans, so geographically, if you look at it, and this isn't necessarily surprising, but I think it's useful to remind people of this, it's not at all consistent across the country. So you're going to see places with more veterans have more VA home loans. That's not surprising, but we also think there's a relationship here with military bases that I'll get into. This is 2012 data. This is the number of VA loans per 10,000 eligible, and I'll be using this throughout, and we're defining the eligible population as veterans who are 65 and under, and also active duty service members, which you got from the census. So I'll walk you through the data sources now. We use Home Mortgage Disclosure Act data for lien originations, 1-year ACS data to get some of these control variables, and also the count of the eligible population. We went out and we got Veteran Service Organization addresses from the Veteran Service Organizations themselves, which were the 4 largest in the country: American Legion, the VFW, Military Officers Association of America, and AMVETS. And we geocoded all of these addresses and assigned them to a county. We got publicly available Department of Defense data, and we made sure to only include the sites that had over 100 personnel at these sites to make sure that we weren't looking at small, tiny bases or ranges. We used Department of Veterans Affairs data for all different types of facilities. That included hospitals, which I just discussed a little bit of rationale for including them, but we also included clinics, vet centers. For those of you who aren't familiar with these are sites where combat veterans go to get services. So there's a lot of social networking that potentially goes on at these sites. We also included cemeteries, and this was an initial falsification test. We thought if we saw a relationship with cemeteries, that would definitely be spurious and would cause us to question whether or not what we're observing is real. We used Zillow data to include county-level house price indexes. So our samples was a panel data set of counties from 2006 through 2017. We included counties that had data from the 1-year ACS for all years, where Zillow house price index data was also available. So we had 657 counties in our final sample. And clearly, we want to state that this may not, what we find may not be generalizable outside of this sample. But what we did, in addition to looking kind of at the initial geographic distribution, is we wanted to look at the distribution of the loans by price and also think about, there's going to be a relationship between the eligible population and the use of this product in counties, and it varies a lot across counties. But what we saw is that, you'd expect a 45-degree line here, and so anything below the 45-degree line are places where there are fewer VA home loans than you would expect given the population. And if you look, these are all the blue dots are high-priced markets. The black triangles are, diamonds are mid-price, and the red is low-price areas. And you can see places like San Francisco, New York, Boston. These counties here are all where we're seeing fewer loans than you would expect given the population. Now, this isn't surprising, but one of the interesting things we've seen is that, these are the scatter plots from 2006 up top all the way to 2017 at the bottom, and the dispersion's been shrinking over time. So we're seeing tighter clustering around the 45-degree line, which is suggesting that we've seen some improvement over time in potentially getting folks in those high-price networks to start using the VA home loan, I think. So, in addition to just looking at these trends, we did do some modeling. We did 2 models. The first I'm going to present here is where we looked at the percent of total loan originations that are VA mortgages. We controlled for time, percent of population that's eligible, and then we did these distance calculations as a way of trying to capture proximity to these institutions. So we had it set to 0 if you were near had a DOD or a military base site in your county. Otherwise, we measured the distance from the centroid to from the county centroid to the site. We did the same thing with VA facilities. We calculated the density of VSO organizations in the county. We included Zillow House Price Index, year-over-year change in price, owner-occupied rates, and the ratio of veteran to non-veteran income. So that's the initial model. I'm not going to bore you with the full results there in the paper, but what we found is that there was some support for this idea that institutions matter. So being near a DoD site, which is represented in the red dotted line, represents if you are in a county with a military base. And you'll see that the percentage of loans drops by 3.7 percentage points if you move to a county that's the median distance, which is 20 miles away from a military base. So we thought that was both substantively and statistically significant. And as we assumed looking at the data initially, the Zillow price index does matter as well. So if you move from that median house price area to a more higher cost area represented by the blue line, you'll lose about 2.1 percentage points in loans. So after doing the percent models, we thought we should also look at the rate. So we did a rate, whereas the number of loans per 10,000 eligible households, or individuals, sorry. And we found that this relationship between the DoD sites was robust. And we found that the Zillow price continued to be significant, but that the relationship changed so much. So if you moved from a place with a median to higher cost area, you actually saw an increase in the number of loans as a rate. And I think this is just that these are areas where the housing market's stronger, where there are more loans going on in particular, and all of the loans, including the VA loans, are increasing in these areas. We did several additional specifications where we looked at FHA loans as the outcome, so both as a percent of total loans, and then we calculated a rate for the eligible population. And we found that this relationship with the DoD sites was robust and that it went away for the FHA measures. There was no evidence that other VA facilities or VSOs had a relationship, and this was somewhat disappointing. We really put quite a bit of effort into trying to create these density measures and also do these geocoding. But that sometimes is what happens, and I think it's important to report on that when it does happen. But I don't lose hope. I mean, we were looking at the county level, so that's one of the kind of limitations of this paper. Potentially, if we were at a finer grain, I think you might see more of a relationship. So one of the things is that we'd like to do next is actually one thing we didn't do in this model is we didn't include the VA and the FHA loan limits. So those actually vary. So in some places, for example, in Martha's Vineyard, the FHA loan limits stay the same, but the VA loan limits actually go up quite a bit to account for the higher price markets. And so we weren't able to capture that right now, but we're thinking about potentially doing that in the future. So proximity to military bases does matter, and I think the housing market around these bases are unique, and it might be worth investigating through potentially qualitative methods, what's going on in these markets, but also understanding what's happening in the higher cost areas, and are veterans being priced out of these markets, or are they choosing to use conventional or FHA loans in these markets? Because we know that vets are a shrinking share of the population, but they're also, particularly the younger vets, potentially more vulnerable, and I think we want to make sure that they're having as much access to homeownership as their predecessors. And then finally, the VA loans are growing as a share of all loans, and the population's declining, and I think that's something that's worth investigating further. I think it has to do with the credit markets, and I'm looking forward to discussing this. Thank you. Yeah, I was on.
Thanks. It's a real pleasure to be here today. I really appreciate the interdisciplinary nature of this conference. I'm learning a lot. And I have the same disclaimer as previous presenters. These are not the views of the Federal Reserve System. Just to give a quick overview, so the share of mortgage loans with VA guarantees continues to rise, and so Kerry showed that very nicely in her presentation. It's a little bit of a puzzle. You know, the VA loans are not available to the whole population. There seems to be a natural limit to the growth if only, say, 10% of the population is eligible, and I'm making up that number, so is that way off?
Nope.
And the fact that the share of FHA mortgages started to trend down. So in as much as you think of as VA and FHA mortgages kind of going after the same audience, FHA is starting to go down, VA isn't. And I would say our understanding of the VA market has not kept pace with its growth. And so I'm very grateful to the authors for providing us with some information, particularly here on the geographic distribution and where these mortgages are more likely to be originated. The headline finding is that VA mortgages are more prevalent in areas with lower house prices in proximity to major military installations. I think the house price result is sensible. I'm saying I think because the amount of the VA guarantee is pretty complicated, so I spent about 30 minutes trying to understand it, and I did not succeed. But I think it's still true as a general fact that the lower prices housing is, the more likely it is that the VA guarantee is going to cover your whole amount. But as Kerry said, it can go up by quite a bit in some of these high-cost areas, more so than FHA. And then the military installation finding is more intriguing, especially since there's no relationship found for other types of veterans institutions. Kerry mentioned this CFPB publication that just came out, which is very nice. The CFPB was able to match credit bureau records with military enrollment records. And they show something kind of interesting, that the delinquency rates for full-time service members are considerably lower in the non-prime space than for other veterans. So you can see that here in the figure on the left. So the solid green line is the active duty VA and the dashed is the inactive veteran. So in a sense, they're a better credit prospect, the people that are currently enrolled in the military. And so my prior is that, you know, around military bases, a larger share of the population is going to be active duty military relative to veterans. Again, that's just my assumption, but assuming that's true, you might think that inasmuch as VA lenders are cherry picking, these are the better credit quality. You don't see this as much in the aggregate. You know, active duty members are something like 17%. I'm looking at Lori and Kerry, but something like that, I believe, of the VA loan population. You know, it's mostly veterans. You know, it's like a minority is the active duty guys, but they might be a disproportionate share around the military bases, and so that might be a particularly interesting place for VA lenders to concentrate. And so why would you care about this question? Obviously, you would care about it because you want to know how can you expand a benefit to populations that might not know about it. The reason I've been thinking about this a lot is I've been worried about the growth of non-bank lenders. All right, so Lori, you're not allowed to answer this question, but here's my pop quiz to wake people up before lunch. Who do you think was the top VA lender in the country in fiscal year 2018?
Quicken.
Nope.
Loan Depot.
Nope. Oh, they're in the top 6. Yeah, so here's the list of the top 20 VA lenders. So the top VA lender is something called Veterans United Home Loans, which started in 2002. If you look at this, I put in bold the number that are non-banks. And I'd just like to ask everyone in this room, because this is a room of people that think about mortgages, go through this and read the name of every non-bank and tell me if that's a name you've ever heard before. I mean, just go through and think about, like, do you know, I mean, Lori does, but do you know New Day Financial? Do you know United Shore Financial Services? Do you know Movement Mortgage? Do you know DHI Mortgage Company? Right, these are names that are pretty unfamiliar, even to most people that specialize in the mortgage market, is the point I want to make to you. And this is a big difference from even a few years ago. So Lori has a very nice piece from 2014, I think, about why do VA loans perform better. She has the top lenders as of 2012. Wells Fargo was almost 17% of VA lending in 2012. You see today they're 2% of VA lending. So this is a big shift of VA lending towards companies that we don't really understand. And let me talk through the two things I worry about. The first is the incentive to ease underwriting standards. So it turns out that the way lenders make money really right now is through originating mortgages. They originate a mortgage, they sell it, they make a nice gain on sale. That's their incentive, to do as much of that as possible. Well, it's harder now to originate mortgages because we're no longer in a refinance market, right? Interest rates have dropped, so the easy money is no longer out there. And the VA has finally put some clamps on some of the abuses in its lending program. It used to be very, very easy to refinance people in VA mortgages. So the easy originations are no longer out there. So you have to go to the purchase market. Here's the other salient fact about mortgage lending. It's really hard to shrink it. This is not a market that shrinks easily. So there's a lot of fixed costs, a lot of personnel. It's hard as demand shrinks for you to shrink your platform with it. So that means if you want to keep up your volume, the way you do it is by easing underwriting standards. And this is a chart that should look very, very familiar to Lynn. This is from the AEI Center on Housing Markets and Finance. John was talking earlier about the constraints to home ownership and talking about down payments are a constraint, a back-end DTI ratio is a constraint. I would say those are not constraints in the VA market. So these are loans with no down payment requirements, and at this point, half of them have DTIs greater than this back-end ratio, John, that you pointed out as a constraint. And you can see that's going up significantly. And when you think through, what's the check and balance on this? Who is it that has an incentive to make sure underwriting is responsible? Well, we've heard a lot from Anna and from the talk last night about how much emotion and stress there is in the mortgage buying process. I think I've gotten a little skeptical about the ability of some homeowners to really advocate for themselves. VA, to the best of my knowledge, does not do a whole lot of upfront checks on the mortgages. The GSEs have invested quite a bit in doing these upfront checks at originations. To the best of my knowledge, VA has not done the same, although I'm very happy to be educated. And then you might think, well, the lenders themselves have an incentive because if the loan goes bad, they're going to have the costs of delinquent servicing, the reputation risk, which actually is true, and I think that is true in the bank market. But if you have a viable option to go out of business, then the consequences a couple of years down the road may not be as binding a factor in your decision. And it turns out VA default servicing is very, very expensive. So this is some data from a paper I wrote with some colleagues at the Fed and at Berkeley. The Fed collects through the stress testing process some information from the big banks on their servicing costs. I think this is from 2016. So if you look at loans in GSE pools, the cost of servicing a loan in foreclosure relative to a performing loan, it's 17 times, which isn't great. But if you look at an FHA or a VA loan, it's 50 times. So if your book shifts from a book of new originations, good credit quality, increasingly to a book of older loans, poorer credit quality, your cost structure is going to really shift. And there's a lot of concerns, at least in my mind, how are these companies going to respond when those delinquencies go up? Are they going to be able to afford these costs? And I know we've had a lot of talk about households and their ability to manage liquidity. It turns out companies are actually often not that good at managing their liquidity either. So a lot of these mortgage companies ran into liquidity problems in the last crisis. So it's just an open question. One of the reasons we need to know about where the communities where there's a lot of these loans is we need to understand where is there pressure on underwriting and where's the possibility where some of these lenders might need to withdraw from the market, and that withdrawal of credit could have a pretty significant effect. So just to conclude, that's the lens I think about this program and about this paper and one of the reasons I think it's really important. But just to conclude again with the contributions, which I think are important. Some very creative use of geocoded data here to show that house prices and proximity to military installations matter. And it sheds a lot of light on why and where these mortgages have increased, as well as what communities will be affected if these lenders come under strain. Thanks.
So can speaker, please?
Okay, so we have half an hour to lunch. We're going to see here whether you have questions or not. But I have a feeling that there must be some questions. And if you could put your name tags up. I'm going to start with Keith, and then Kate and Sarah, and Emily and Roberto. So Keith,
Sure.
Kate, Sarah, Emily, and Roberto. And then I'll take it from there.
So this is a question for Kerry. Kerry, you're conceptualizing this as sort of a social network effect. You know, if I think about where VA hospitals are located, they're in Atlanta, they're in Denver, they're sort of in urban markets. If I think about where bases are, they're more likely to be out in rural areas. And so I wonder, is it possible that sort of what you're seeing is the fact that the bases are creating enough market density that the sort of support structure that you need in a market to originate VA loans is just sort of developing in areas that your model isn't otherwise predicting, whereas for the other facilities, you know, just by virtue of being in a larger, sort of more densely populated area, that network is springing up. So I guess it sort of goes to sort of the hypothesis of what's driving that activity around your bases, whether it's a social network or whether it's a market effect.
So I don't think we can say for certain, but it's definitely worth looking into. I do think that there are VA medical centers throughout the country, and you know, I live in Western Mass, and there's one out in Northampton and more kind of a rural market, and so it's definitely that the bases are in places. I wish I could put up the map of the bases, because we didn't actually include it in this paper, but we do have maps of all these locations, and there are actually quite a few in California, right along the coast, and along the coast in urban areas as well. And those are higher cost housing markets as well, but they weren't any of the blue dots that we were seeing, like the San Diegos of the world and things like that. So I do think, you know, clearly there are unobserved effects that we weren't able to capture in this data, and we'd like to do more to understand it. But I think the results would still continue to be robust, and potentially, you know, through my conversations with veterans, I do think that being near a base has advantages for vets, and that folks often want to remain near the base because of their social networks and ties and privileges that they have to that base. So I do think that it's something, it's not just the housing market, I think it is also something about the community and the networks that exist around those bases that are really different than the rest of the country.
This question is for Jonathan. It's actually a comment and a question. I just want to echo Brett's point about how relevant this paper is for practitioners. As a practitioner at Prosperity Now, looking at that lower end, the 10,500 and below, I would really encourage you to put something out of just about that. At working in down payment assistance programs, there is constantly a question about what is a match, what is the amount. And so I think just that as a guiding post is super helpful. So I think kind of, someone said yesterday about multiple papers in one, I think just focusing on that 10,500 below would be very useful. And then I have a question that's similar to another question earlier. Did you think about, or have you thought about looking at the supply side? So you make a really great argument, again, thinking about the 10,500 below. In the paper it says, 19 million people would be eligible, at the median for whatever their market is. What's the supply? How many median priced homes are there in any of those markets? I just think that would be another additional interesting question.
Yeah, sure. On the supply side, no. We have not tried to grapple with what, if something happened at scale, obviously that would there would be general equilibrium effects that are beyond what we capture. And those not, my understanding of shared equity is that the scale of it now is not, the risk isn't that 19 million households are going to suddenly enter homeownership. It's that incrementally over time that might build up. And so we're abstracting away from it a bit, but that we could think more about what the supply side implications might be. I do want to say that the point about creating a practitioner-oriented document is well taken, and I think that's probably something that we will do, and if nothing else, it will go into the State of the Nation's Housing and some of the other reports, and and the like that we produce. Losing my, I thought that I had another comment for you on down payment assistance, but it'll come to me and maybe we can talk later. Great, thank you. Sarah?
Yeah. The question is actually for all panelists, and it's inspired a little by Jeff's challenge to think big. I guess my question is whether each of you could dig a little deeper into what exactly is the market failure that's causing the problem you see, and does your policy solution address that market failure? Particularly interested in the role of the way that these intermediaries are compensated and the ways that consumers are able to get different information by shopping. And so there were some suggestions about what could address that, but I was wondering if you could talk about it a little more.
Yeah, should I start? Yeah, okay. Yeah, I mean, I think that I'm not an economist, but I know enough to say that I think it's an information asymmetry problem. You know, there's a real strong advantage to the intermediaries here, and their incentives are not aligned with borrowers' incentives. You know, there's no, I don't know that there's a way that you could create a fiduciary duty for a mortgage lender, but you know, better aligning the originator incentives or the broker incentives with the borrower's interests would be a major step forward. And I think if there were some way to, you know, provide mechanisms for getting information more readily and making, we in the paper have a suggestion that maybe there could be a clearinghouse to submit a common mortgage application and a single set of documentation, and brokers would say that that's the service that they're designed to provide, but they're not comprehensive, and you know, may not include VA products or the One program, or you know, products that may be really well suited to people. And so if there were some kind of, you know, like kayak for mortgages, and you could have your information sent to different lenders that have different characteristics. In a smoother way, you could take advantage of technology in that way for people who are able to get online, and make sure that it reaches to the housing finance agencies and the niche products. You know, for us, that's where we started with this idea. But I really appreciated Max's suggestion of having higher training on or standards on ethics and the relationships that realtors and lenders have with their clients. You know, maybe best practices on encouraging shopping around and audits around that or something.
Can I ask just a quick follow-up question for Anna that's related? And so I'm curious if any of the individuals that you followed broke their relationship with the trusted intermediary. That it seems like, to the extent that there's room for a nudge, the most effective place is as early as you can about getting them into the right track where momentum can take its effect. And so I'm curious if anyone had such a negative relationship that they actually were able to remove themselves from one set of professionals and search for another.
I have to look at Hannah. I think almost no. Maybe Nancy, because she was really connected to her. They're all pseudonyms. She was really connected to the lawyer that she wanted to use for the closing. So that was a sort of atypical professional she was trusting.
And then the forced situations where someone got to the end, right, and the product wasn't there, that kind of forced a breakup.
Thanks. And I don't think it was something that they wanted to do, because in one case it was 24 hours before their closing, right? Yeah, so I don't think we saw really any instances that would play to that point, John.
So I want to keep things moving. I just want to mention one thing though, which is a structural issue, right? So if you get to you have a house, you have a limited amount of time, you're under a lot of pressure. That's a market failure, right? In the sense that that's exactly when you could use more information and more shopping. And that's exactly when you don't want to do anything, upset the apple cart, and you're praying that your loan gets processed in time to have everything go forward. And Emily, Roberto, then Steve Malpezzi, and Jeff Sable, just keep me moving.
Emily Theodos with Grounded Solutions Network. We are the national membership organization of shared equity homeownership programs, so I have to thank John and all the co-authors because I feel like you wrote this for us, so thank you. And as the national policy director, I also have to really emphasize that I would love that policy derivative work to be produced. But if not, I'm hoping that you can indulge me with just a couple comments on the paper. I want to emphasize something that Brett said, which is around messaging. I think that there were a couple things that didn't come out in the paper, especially for people who may not be as familiar with shared equity or this is like a new idea for them. I think it's important to emphasize that this is not, if your only option is to get into some weak homeownership kind of solution, but I think that this is really about emphasizing that this is sort of sitting between rental and private market homeownership. And I think that you note some of that stewardship and some of that backstopping that happens. But I think it's important to emphasize that there's like a benefit for our entire market if we can stabilize lower income homeowners, and that this is often a stepping stone into private market homeownership. The next point I want to make is I really appreciated you emphasizing mixed markets. But I think that the point that was missed in some of that was that by emphasizing building shared equity in mixed markets, you're actually creating a buffer against gentrification. You're promoting mixed-income communities. And I think that that's like a huge public policy point and a huge benefit that was obfuscated in the paper. The last thing I wanted, another thing I wanted to point out, not last, sorry, was I think that one of the markets that was potentially missed, so when we think about demand, is exactly who is being targeted around reverse mortgages. And I know that this is sort of an out there idea, but to think about perhaps a shared equity homeownership solution could be utilized as a way to be giving equity to current homeowners in return for them agreeing to limit their appreciation on the back end. And I think that that could at some point in time be an innovative public policy solution. The next thing I wanted to...
Emily, just last point.
Sorry, the last point I wanted to make was just around the sort of the emphasis on like this has to be an economically rational decision. And I think when I sat back and I was thinking about that 8 million, I think that while it needs to be an economically rational decision to agree to restrictions for shared equity, it's also a really big economic rational decision to you were just talking about this, to not be paying so much on the mortgage. And so I actually think that the market of buyers who would be interested in this may potentially be larger based upon the framing of the definition. So thank you for that. I appreciate it.
Yeah, I guess I would say, in the presentation I didn't talk much about the models themselves. We've done more of that in the paper, and yeah, those comments are well taken, and I think we probably, in revisions, will think more about exactly how to talk about how the numbers relate to different kinds of shared equity programs.
Thank you.
This is coming for John too. I have a couple of them. In the good old days, we used to talk about the housing ladder. I don't know if you all recall. You rent first and then you buy a starter home. I think your paper, to me at least, will have much more effective policy impact if you focus your work in prime home buying years for the household. To me, an 18-year-old or a millennial squatting in the parents' basement while they pay off their student loan is probably the right choice. I don't see that as a potential home buyer. So it seems to me that if you have age of the householder, you may be able to narrow that estimate about what is needed in terms of down payment and other things more effectively. And the other point is with regard to house prices. A one-person household doesn't need as much house as a 7-person household. Can you somehow tailor price based on household size? Thank you.
We talked about that last point, and I'm lucky that Kristin is a family demographer and really wanted to explore there. I don't know that we're there yet, but yeah, it's well taken. It might be something that we do, and I really appreciate the separating by age, and I would think also whether or not someone's ever owned before, trying to take advantage of sort of the full housing cycle.
Thank you.
Great. So Got a lot of people. We're going to try to get through everybody. Steve Malpese, Jeff Sable, and Mark Schroeder.
So a couple of comments. Maybe there'll be a question embedded about also about the shared equity paper, which is very interesting. First, to expand on Emily Faden's point about this is not all new. People with memories of olden times in the early 70s when we started to move away from 30-year fixed rate to a broader menu of mortgage products. There was a lot of interest in shared equity mortgages and similar vehicles. You might start, anyone who is interested might start with, it's easy to find online. Federal Reserve Bank of Boston had a compendium of papers, really good ones on alternative mortgage designs in 1975 that include the shared equity mortgage. Second point would be, as you noted in the paper, skimming it, there's lots of different detailed designs of how you would do shared equity. I would say the devil's in the details. Having observed them in Madison, Wisconsin, they come up with a design that had all the wealth building effects of renting with the transaction costs of owning, plus some additional transaction costs on top of it. And there's a lot of experience, there's some experience in other countries as well, including in very different forms in Kenya and Chile. And a lot of these experiences would show some of the potential pitfalls and things to watch out for. So I could provide some, initial pointing in that direction. But the final point is, I'm a little concerned where you basically are saying we're going to tackle affordability and pricing issues by creating a product where you basically are guaranteeing an increase in excess demand for a product that's going to be self-limiting given what I'm sure will be small resources available to provide the subsidies embedded in it. And then you've got the whole problem we face in all the programs, but the horizontal equity problem. So who gets to get this $100,000, $25,000 to $100,000 subsidy? So I guess I come back to, hey, what about some vouchers?
So I just quickly on that, I will say that's part of the point in talking about the other products. I'm not taking a position on shared appreciation mortgages or any of those, and there are good models and bad, and they don't necessarily, luckily the estimates don't have to take into account product design, and fully agree with you that they're on product design, the devil is in the details.
I have 9 people, and so what we're going to do is ask people to limit their comments to 1 minute, and we're going to take 2 at once before, and we don't necessarily need to respond. I think the main thing is we want to hear from you. So Jeff and then Mark.
Lynn and I have a paper on housing affordability with excellent research assistance by Don Horn's daughter. And we look at the town level what percentage of the units can be purchased by households of a given household size, by the way, and income level. And you base your potential home buyers on the median house price, and we make the point that the median is not a good measure of affordability. LMI households are not going to be buying the median house, they're going to be buying on the lower tail. So it makes sense to think about looking at the lower tail of the distribution, and you may actually have a lot more potential home buyers who can purchase houses at prices below the median, which I think is the right market to think about. So that's just a point.
Yeah, we will have tables. I use the median in the presentation. We've replicated all the estimates at the 50th, the 40th, the 25th, and the 10th. And so supplemental tables to this will have extra details. Sorry, Jeff.
Mark, are you still coming?
I guess so. I guess this is merely a comment. Those of you who enjoyed Anna and Anna's paper should be aware that the federal government could never have done it, could never have sponsored it. OMB would have prevented its ever having happened. And on the grounds that such a study would have invaded their privacy, the privacy of the subjects, and compelled them to participate by excessive whatever incentives. I don't know at what time the government will change that policy, but thank you for doing it, and thank you for supporting it, Fannie Mae.
Yeah, here. Catherine Kay, and then Ray Boshara.
Thank you. This is actually for both Anna and John. And I sent a picture of the title and abstract of that paper to my wife, with whom I'm trying to buy a home pretty unsuccessfully, and several of our friends and my mom, and everyone was just like, laugh or cry. It hit hard. So, John, your paper flagged non-housing debt as one of the potential financial barriers, and Anna, you mentioned being surprised by how prevalent college education was among the particularly lower and moderate income folks. And I was just wondering, like, where student loans came up specifically in your data and in your interviews and recordings of the strife of this awful process.
So we're going to hear from Ray, and then you can both respond.
Just a brief comment inspired by Hannah's remark that the barriers to entry to be an agent or a broker are pretty low. Yet agents get 6%, which is really high. It doesn't seem commensurate with the value they add. So it's just a plea to let's talk about wealth stripping as much as we do wealth building. And for low-income families to lose that much of their wealth in the transaction, really, I don't know if anything can be changed on that front, but it's something we should think more about.
Very appreciated comment and suggestion, Ray. Thank you so much for adding. Good luck.
4 times the chart?
Yeah, student debt, maybe we should follow up later. It wasn't hugely prevalent in the interviews, but we can follow up a little bit.
Yeah, and education debt is there. I don't remember off the top of my head how many of the 12% plus that accounted for, but we can find that out.
Okay, great. Gary and Jake.
I cede my time.
You cede your time.
So this is a comment for Anna. I think first of all, you really captured a lot of the input that I hear from first-time homebuyers, so I talk to on the phone or on the road or wherever I am. But the other thing I would say is that I think when it comes to first-time homebuyers in particular, there's a lot of unknowns that they face, and they might never find out that they made a mistake or that they were acting under incorrect information. What always comes to my mind as the poster child for this is when you go to meet with a loan officer, a lot of times the first thing they'll try to get you to do is allow them to pull credit. And a lot of borrowers believe that when they get their credit repulled by other lenders, their credit score is going to go down. In fact, that's not the case, because there's actually a regulation that went through with Dodd-Frank, I believe, that says from the first time of credit pull in a home mortgage application, you can keep getting your credit pulled by different lenders. It's not going to affect your credit score. Borrowers don't know that, though. So I think one thing that might be helpful is getting input from home buyer counselors, other kinds of independent third parties, and there's also some very honest loan officers that I know that might be able to sort of give you a little bit more information on that.
Great. Thank you.
Joe and then Stephanie.
Joe Weisbord with Fannie Mae. These were all really interesting papers, and I bring another practitioner perspective. Lots of questions, but the one that is sort of weighing on my mind at the moment is the survey research that my Fannie Mae colleagues did on shopping behavior that led to the project that Anna and Hannah just presented. I think we were all stunned at how limited shopping behavior was, and also by some of the differentials across race and ethnicity. But all this was informed by sort of just a intuitive belief that shopping is always good. And I'm just wondering if any of the panelists, or frankly anyone in the room, has thought more about what are the, and given the policy lift to creating a more level playing field and reducing information asymmetry in the mortgage market, how beneficial is shopping? Can we quantify to say, if you've shopped 2 or 3 lenders, you're saving X basis points, or you're achieving, especially in a post-Dodd-Frank world where we've eliminated some of the most predatory products.
Go ahead.
I was suggesting, Anna, that the apt work on shopping is probably the most beneficial. I think timing is a very central part of that, that shopping, depending on what stage of the process you are in, could have very, very different impacts. I think you probably, understand the process and would have any insights that I would add from there.
Right, and I think the best data that we have, I mean, what we cite in our paper is pre-recession research has shown that shopping improves mortgage costs, but then these products were regulated out of the market. So I don't think, I don't have a lot of great information on this. Maybe Sarah, you have information about how shopping affects.
I'll just throw out a thought, which is that the measure of shopping benefit is not necessarily the price difference in the loan, but the sense of personal empowerment and power that someone and control someone has over underwriting their own affordability and understanding what the different players are in the process. So I think there's more to the metric than just, did you save $100 over a 30-year loan?
But is that sufficient incentive to get people to shop?
Yes.
So we have 4 minutes. Hannah's going to comment, then we'll hear from Stephanie and Tara, and if there's any time, we'll answer any questions.
So I think there was, Freddie Mac actually did a study fairly recently where they tried to estimate some of the costs, at least from the interest rate savings. So that might be kind of one place to start and then kind of build on that research. I think that could be an interesting project.
Just had a quick question for John. You might have addressed this already. What about credit? So you didn't say anything about like credit qualifications, and you may have said that right up front, and I know EHS doesn't have that, but I didn't know if that's part of your discussion at all. And then another quick question for Anna about technology and the role of technology. Did any of these folks talk about fintech lending or going online and trying to find mortgages or looking for information in that way? So those are just 2 quick questions.
We're going to wait for Tara, and then you'll have a chance to answer. Go ahead.
So just one comment as well on the benefits from shopping around. I think there are some other things there that could be missing too. So I'm glad you also made that point around down payment assistance or other things that it's not necessarily about the rate so much. So, there are lenders, I think even in DC, there's a lot of home buyer programs, but a lot of information asymmetry or sort of lack of knowledge on both actually prospective home buyers and on lenders or brokers. So shopping around could, there's more wrapped up in that than just the rate. Just quickly to Stephanie's point, we watched people using online mortgage calculators. Okay. So certainly that's part of what they're doing, using the embedded affordability calculators on Zillow and Realtor when they're there. But we didn't see people gravitating towards online-only lenders. They didn't seem to be interested in that at all.
To Stephanie, you didn't miss it, it's not there. It's a limitation of the SIP. We don't have credit information, so when you're seeing those counts, that includes the full distribution of credit scores in that group, so not all of those are going to qualify. Just to echo Sarah's point too, HUD's housing counseling study, measures of confidence and satisfaction are some of the impacts that jump out the strongest. And so it sparked some thinking about what's the value of that? If I come through the home search process and maybe I haven't gotten more price quotes, but it's removed doubts about the process from me. Well, I guess I should say what we don't know is that translating into other kind of intangibles that we're not measuring well and therefore aren't seeing impacts. And so there's questions around sort of what's the innate value of that on its own, and then how does it translate into other things? In terms of getting price benefits, again, I think for me at least one of the lessons of that study is as early as you can intervene, that's where you'll actually move some of the harder measures.
So we are just about out of time. I just want to thank all of you for taking a little time to think about not just what is, but what could or should be, because I'm realistic, right? That we're not going to have products if it doesn't make sense for the lenders to provide them. But at the same time, I don't think we just need to sit here and take it if we have a system that leads people to really exercise behavior that is destructive for them, or if there are people who could be helped in important ways that aren't being helped, or you know, potentially if there are people who are, or if there are non-banks, for example, that are making loans that maybe they shouldn't be making because they don't have any sort of long-term institutional incentives to stay in business. So keep thinking about it, and look forward to continuing the conversation. So thank you all.
As we described, we're going to go to lunch now. Lunch is back where we've had our other meals in Malkin. So you go over this way, go down to the third floor, across the floor, and back up. Yes, this classroom will should be safe. Can you lock the door? Yeah,